Hey, DT, can you take a look at UNH? Oh, sure. And what do you want to do in UNH? Or you got an existing position? Yeah, you have an iron condor? Well, right now, you got an IV rank of 27, IVX of about 42%. Good IV. Yeah. The 310, 320. So you're being tested here. So I assume you probably got something like this on the put side. No, it's September 19th. Oh. Roll it if you can. What's the strikes on the put side? 230. Oh, 230. Yeah, your put side is already a max winner. Yeah, no point in keeping this thing on, right? These are 1 delta options. I mean, it's 100% winner at this point. So nothing to do there. Just let's close, or you just let that expire. Hell, you ain't even got to close it. But what you should do, roll this. So let me clear the screen to get the put spread off, and then so the credit call credit spread's trading at 360 in this expiration. 16 days to go. If we go a month out, do this one, it's trading at 402. That's not bad. 40 cents for the roll. You could even roll it up a little bit. Now you 325 credit, but here's the thing. You could sell another put credit spread on the other side to finance moving this back up and get into a new iron condor. If you can roll that back into a new iron condor, I would do it. Go out to the 44-day cycle. So roll the call credit spread out to the next month. Adjust the strikes to where you're comfortable. Sell the put credit spread side against it. All right. Yeah. Anything else from anybody? Now, if you're able to pull off that roll, KJ, basically you won on the put side of the iron condor. So you made, you didn't make much on the put side because it's only 1/2 of an iron condor, but you might have made a buck and a half on the put credit spread. And then you roll the call credit spread out to the new iron condor, you know, so you're back into an iron condor, but at least you made a buck or so on the first one. So, I mean, you made a little something on it. If you close iron condor and open new, it's the same as a roll. Yeah, you can always just close the position and put on the new position. Obviously, most people are rolling so they can track it all as one trade. That way they know if they eventually came out ahead, right? But yeah, a roll does not save you a loss, right? When you roll a losing trade, you're essentially closing a trade for a loss and then putting on a new position. You know, it's not really, you're not preventing a loss. You actually took the loss. It's just the way it's logged in your trading platform. It's just carrying over the loss into the new trade. So you start the new trade down money, right? That you've got to recover. So if I'm down $100 on something and I roll to the next month, you know, I'm still down $100 when I roll to the new position, right? I just haven't closed it technically for that loss yet. But yeah, you haven't saved yourself any money by rolling. It's just how it looks on paper, you know. How would you trade Broadcom if you had to today? Yeah, I went over a couple of possible trades earlier. I'd probably play it because the IV rank's not great. Only 22. The IVX is not bad, 47%. If you got a bigger account, I'd probably do like a wide strangle, like a 10 delta strangle. Make about $5 credit and buy power reduction of 3,000. It's not horrible, you know, for really wide strangle. If you can't do naked options in this, you got to be able to do at least $10 wide spreads. So I'd probably do an iron condor. I'd do the 21 delta short put and then go $10 wide. And I'd do the 14 delta short call, $10 wide. In this case, we'll lean slightly bullish, but very slightly. And you receive a 282 credit versus a 723 buying power reduction, right? It's $10 wide, $1,000. If you get a 280 credit, that means you're risking 720. But that's about the ratio I typically like, you know, somewhere between 2 to 1 and 3 to 1 on the risk reward. This is close to 3 to 1. But I'd probably do one of those trades, depending on, again, your account size and how much risk you want to take on the trade. You want it something shorter dated. If you just wanted to play it directional, you had a directional assumption, bullish or bearish, you could always, especially because tomorrow is Friday, so butterflies work great as one-day trades because you really have to hold them late into the cycle for them to profit. But if you wanted to play like a butterfly spread, let's say $7.50 wide on each side, and play for the expected move to the upside with a call butterfly, you pay about 90 cents for the chance to win 670 or so. And if you were bearish, you could do a put butterfly somewhere around the expected move. Once again, we'll go $7.50 wide, pay about 73 cents in this case for the put butterfly, or the chance to win about 670. Realistically, that max profit, you're only going to get that at expiration. You hold all the way to expiration, which is not what you want to do with a butterfly, because you could end up in a situation where some options are in the money, but some aren't, and you're going to end up with shares that you probably don't want. So manage it early. Realistically, though, if you get the move on either the call butterfly or the put butterfly, if you get the move going your way, you'll probably make 100, 200 bucks, you know, depending on exactly where in the spread. If it's really in the center of the spread, yeah, you'll probably make a couple $100 on the play. You're only risking $75. Now, it's a low probability play, right? Because you got to get direction right. Not just direction, but you got to get direction, and you got to get it to fall in this range. Now, if it makes a huge move in your direction, well, if it blows past the butterfly, you're still going to lose, right? So this is one of those trades, even if you get direction right, if you don't get it to the magnitude that you're betting on into this range, well, you still lose. But, you know, this is a fun little gambling kind of trade, you know, a short-dated trade. So, yeah, just different ways to play it. Those are my go-tos, though. I go to the monthly cycle and do a strangle or an iron condor if it's a big product, and play for the volatility crush. If I have a strong directional assumption, I go to the weekly cycle, play it just for the 1 week move, and then bet up or down, either with butterflies, especially on, again, later in the week. Butterflies work great as a one-day trade. If it was a earlier in the week kind of earnings, like if it was on a Monday or Tuesday, then because the butterflies don't work as well because they require time to pass a little bit, and I don't want to hold it all week. You know, a lot of times I'll just do a debit spread for those. At the money debit spread, you know, put debit spread to the downside, or at the money call debit spread to the upside. 50-50 kind of shot on those. So different ways to play them. Let's see. Yeah. Wow. You have so many ideas. Thanks. Yeah. It just depends on what you want to do. Most of the time, I would say 95% of the time when I make a trade, I don't have a directional assumption. So that's why strangles and iron condors make sense most of the time on those earnings trades. If I do have a directional assumption for whatever reason, you know, because sometimes, you know, you're like, hey, you know what? I just feel like this thing is really oversold or overbought, or last 3 times this thing had earnings, it went up. I think it's going to go, you know, sometimes you just have, you know, that gut feeling. You want to be directional. If you want to be directional, do it in a short dated trade, do it with butterfly spreads or do it with debit spreads, keep them small, you know, you don't make a big bet because those are low probability trades. They're not your money makers, right? So they shouldn't be like a core part of, you know, something you do all the time. But there's nothing wrong with, you know, gambling, you know, small amounts of money on some directional trades every now and then. Just be smart about it. Don't go all Wall Street bets, right? A lot of times too on these directional trades, if I'm putting on a directional trade, a lot of times it has to do with, do I need long deltas or short deltas? For example, most of the time I've got so many long delta trades on. I've got so many bullish trades on in my portfolio. If I'm playing like one of the Mag 7 stocks for earnings, let's imagine Microsoft had earnings today. You know, one of the biggest companies, if not the biggest company, market cap wise, it's going to move the market around in a big way. Well, I'm already long the market. It wouldn't make sense for me to put on a long or a bullish Microsoft trade, because I'm already bullish in Microsoft, because I'm bullish in ES and MES, right? I've already got that trade on. So if I was playing Microsoft for earnings that day, I'd put on a bearish trade, right? As a hedge. That way, if the market does go down tomorrow, well, I'm going to make money on my Microsoft trade, because Microsoft will be the one that really pushed the market lower. A lot of times it just depends on what else you have on. Too many people try to overthink being bullish or bearish on some of these trades. A lot of times your portfolio will tell you, I need a bullish trade right now. I need a bearish trade right now. Or my portfolio looks perfect right now. But I still want to put on some trades. We'll put on some neutral trades, things that don't add or take away any of your deltas, right?